Get off the sidelines and take control of your financial future at www.tackletrading.com. Get in the game.
Hello, everybody. This is Noah Davidson, A.K.A. Coach D with TackleTrading.com. And I felt inspired today to create a little video to share an important message and an important lesson for everybody out there. And it's something that is so important. It's not just important for people to understand. I believe it's vital. It's absolutely vital that people understand. Now, what really inspired me and motivated me to do this is, one, this is what I do anyway, is I share this message with people all over the US, and I share this with people all over the world on the internet. And I was, motivated to do this because the other day a friend of mine posted a cartoon on Facebook, and I thought it was funny. I looked at it and I kind of laughed and chuckled at it, and I shared it on my wall, knowing full well that the vast majority of people out there won't understand the content or the context of this cartoon. Those of my friends out there in Facebook who are, former students of mine who have been trading, certainly do understand it. And if you do understand it, congratulations, you're way ahead of the curve. But if you don't, that's a problem, because everybody should understand what the content and the context of this cartoon is, especially if you care about your money. So if you have a 401k, or you have an IRA or an RSP if you're Canadian, if you own mutual funds of any kind, if you own any stocks, if you own any bonds, if you own any precious metals, these are things you need to understand, because the market conditions that are coming ahead of us, we have a potential for a huge downward bear market coming. And I'm going to try and help you understand this cartoon, the context and the content of this cartoon. And if you believe that you'd be more likely to take control of your investments, or more likely to start investing if you felt more confident about what you're doing, well, we're here to help you with that. So this is an old saying I'm sure you've heard before, that a fool and his money are soon parted. And if you have trusted your money to somebody else, which technically if you have your money in a 401k, or if you are in mutual funds, that's what you have done. And if you are not in a place where you are self-directing your IRA or self-directing your own investment accounts, then you are essentially trusting other people with your money. And really, I'll do a whole separate video on that so you can really understand the costs of what that is. And I'll actually just kind of compare and contrast it for you, and basically show you that the traditional conventional wisdom investment vehicles are really designed not to benefit you, but to benefit them, to benefit the convention, because they don't put any money in, they have no risk. So we're going to start out by, one, just taking a real basic walk down Wall Street. You probably are familiar with the concept of the bulls and the bears. And the reason that the stock market has adopted those mascots has a lot to do with the animals themselves. So if you look at like Chicago Bulls and Chicago Bears, and you ever wondered why Chicago has the teams, the Bulls and the Bears, well, they're one of the major financial centers in the world, and that's where the commodity exchanges are, that's where the options exchange are. And it is, a pretty simple way to understand the way that the markets function. Once upon a time, I lived in Spain, and I decided to go do the running of the bulls with some friends of mine, and we went out and we actually decided to go run with the bulls. And one of the things I learned is that the bulls, when they come charging, they will put their head down, and they come with a very powerful, mighty upward thrust to subdue their foe. And you do not mess with the bull, because you will get the horns. So bulls, with that upward thrust, that's why they get the mascot name for the people who believe the market's going to go up. Now a bear, and I don't know if you've ever come across a bear out there, a bear will come and subdue its prey and pin it down, and it will come down with its mighty claws. And so that's why we have the bears being the mascot of the downward, people who speculate that the market's going to go down. Now, let's take that and start to understand how it is that bulls make money and how it is that bears make money. Bulls believe that the price of an investment will go higher. Purchasing the financial asset could yield a profit if their bias is correct. The risk of loss occurs if the prices fall instead of going up. And they start out a position, they open up an investment position or a trading position by buying to open. They buy whatever the asset is, whether it's a stock, So they make their money when markets go up. And it's another way of stating it is when you buy to open, they call that a long position. And primarily because most people look at the markets as an investment, they're in it for the long haul, or they're opening and it takes a long time for the markets to go up. Now here's an example of a long position that recently was able to pull off. This is an example of the stock Starbucks. And recently Starbucks broke to new highs, retested. You can actually see there's a very common little pattern in here that traders use. And it broke to new highs. So if we had bought that at 50 and we picked up 100 shares at 50 and the current price it rose up to 54.24, well, that would be a $4.24 profit per share. So if you had 100 shares, you'd have a $424 profit. If you had 1,000 shares, you'd have a $4,240 profit. That's pretty simple. I think most people understand that. Now, the bears, on the other hand, believe that the price of a stock or price of a financial instrument will go lower. If they sell the stock, they could yield a profit if their bias is correct. The risk of loss occurs if prices rise instead of fall, and they actually start their position out by selling to open. It's called a short position. Now, they call it a short position because on average, when the stocks fall, they fall quick, they fall fast, and that crash doesn't last for a long time before they recover. And the masses are out there trying to invest and buy stocks, and so they actually call it a short position, and they make their money when the stocks go down. Now, that's something that is a little harder for people to understand on average. We're going to start out by trying to help you understand how it is that the bears make their money. And the bears, in order to make their money, they sell the stock. Now, they're going to sell a stock they don't actually own. And, this is a little harder for people to understand, but the first step in doing this is to actually borrow the stock from the broker. And the broker will lend a trader or an investor their stock from one of their other holders, somebody else who actually owns the stock that uses the same broker. It's kind of based off of a fractional reserve, just like a bank. When you go into a bank to borrow money, the money that they're lending you isn't the bank's money, it's based off of the depositor's money, and it's based off of fractional reserve. So if somebody were to deposit $1,000 in the bank can now lend out up to $9,000 in a fractional reserve scenario based off of the deposit. And so they lend out money to the borrowers based off of the deposits of their other customers. And so they're happy to do that because when they lend you the money, they get to charge you interest, and you'll pay that loan back and you'll make payments on it. And they can call the loan due at any time because it's not your money, but they want to make money on the interest. So they're glad to lend it to you. Now that's the same for brokers because the masses out there are taught to buy and hold. And if they buy and hold, that means the stock's just sitting in their account, and day to day goes up and down and fluctuates in price, and stocks go up and stocks go down. Well, what they will do is they will generate some income off of that stock ownership by lending it out to other traders, and every time they buy or sell, they get a commission. Plus, they get to charge them interest. It's called the broker call rate. And so when you borrow shares to sell short, they charge you a little bit of interest. So step 1 is to borrow the stock from the broker, and step 2 is to sell the stock in the market and collect the current price. You'd get a credit put into your account. Step 3 is to buy the stock back, and if you can buy it back cheaper than you sold it for, you'll have a profit. Step 4 is to return the stock to your broker, and all those 4 steps are basically boiled down into 2 steps. You simply click the sell button, and you click the buy button. So I'm going to take 2 seconds here and just go and show you very quickly how something like that would work. If I believed that the stock Walmart was going to go down, I could very, very quickly open up a chart of Walmart. And the stock has currently been trending down, and I believe the stock price is going to go lower. Now it just broke through a critical floor, and it's got a pattern that traders would see. And so if we were to go sell it right now, we could collect $71.86 per share. And if it dropped lower, we could profit from that. So now, if we were to go and do that, you'll notice over here they've got this little thing up here that says ETB. Now that's not going to make sense to anybody unless they understood it. It means it's easy to borrow. They have lots of people who own Walmart. So borrowing gets a piece of cake, and you don't have to ask permission. You don't need to be creditworthy or anything like that. You just simply go click the sell button. When you go click the sell button, it'll open up a ticket, and it'll put you in at a negative 100 shares. So if I were to go, put in whatever number of shares you want, you get to choose. You can put in 50 shares, 20 shares, 100 shares, 1,000 shares, doesn't matter. So if you click the sell button, you will then wind up with a short position. Now I'm going to go ahead and show you another short position versus a long position that we have here, just on some other random stock positions. And here's an example of some long and short positions. So down here, I have minus 500 shares of Seagate Technologies, minus 500 shares. And if I were to buy it back today, that'd be a $4,675 profit. If I look over here and I have Skyworks, it's got plus 300 shares. And if I were to close that one out today, that one would have a $5,813 profit. Now to balance the book, that's a positive number of shares on my book. That's a negative number of shares on the book. That would indicate the shares that we owe that we'd have to return back to the broker. And it's just that simple. You sold them short, you owe the shares. You bought them long, you own the shares. And that's as simple as it can be. So hopefully that's kind of eye-opening for you. Now, that's kind of the basic idea, simple steps. So let me go ahead and kind of pick this up from where we left off. I'm going to give you an example here of American Airlines. Well, American Airlines, if we sold short at 46 as it broke down here, and the current price is now 39, if we sold at 46 and it dropped to 39, well, that's a $7 profit. So if you had 100 shares short, you'd have a $700 profit. If you had 1,000 shares short, you'd have a $7,000 profit. You sold to open minus 100 shares or minus 1,000 shares or however many you chose, and you would need to buy to close. And it would simply be clicking the sell button and clicking the buy button. Now, to help you understand the short selling process and to let you know that it's really not that foreign, I'm going to give you an example. So let's say you had an infomercial product. And I know you've all seen an infomercial or two. And the infomercials are always the same. Call now and have your credit card ready. So the product they're selling is just $99.95 plus shipping and handling. And then they say, call now, have your credit card ready, and please allow 6 to 8 weeks for shipping and handling. And that's kind of a, wait a minute, what? 6 to 8 weeks? Why on earth would it take 6 to 8 weeks? They could send that like UPS, postal service ground. My grandmother could deliver that quicker in her walker than 6 to 8 weeks. Why do they need 6 to 8 weeks? Well, it's because they sold you the product they actually don't have. They took pre-orders. They sold something they didn't own with the intent of buying it and giving it to you. So they go and buy it from the manufacturer for the price of $29.95. And then they charged you the $99.95. So they now have the expense of $29.95, but they got the money from you first. And so they have a $70 profit. You paid for the shipping and handling. And 6 to 8 weeks later, when the product shows up, you are a happy camper. You got what you paid for. So they sold first, then they bought second. That's a pretty simple concept. Now you can go down to Big Box Mart and buy the exact same infomercial product with the sticker on the box as seen on TV, and you can get the product for the same price. Now, in order to have that product on their shelves, Big Box Mart already purchased it for the $29.95 from the manufacturer. They had it shipped, warehouse, and they put it on display. It still has the same sticker on the box that says as seen on TV, which is the most important part, right? And they marked it up to the same $99.95. And they still have the exact same $70 profit margin. The difference was the order of operation. They were long. They bought first so that they could then sell second at a markup. So that's a very simple example of long versus short. And again, the most important part of that is that it was as seen on TV, because if it was as seen on TV, it's got to be good, right? So now that kind of brings me back to these pictures here, bull versus bear, and those little slanty lines in abstract art. If, again, you still don't understand that, I want to help you take that and finish that. These are what are called P&L graphs, or profit and loss graphs. And they represent the potential risk/reward, or the profits and losses that a bull would incur versus a bear. And it's a very simple technique. And so I want to teach you how P&L graphs work. Because if you don't understand P&L graphs, odds are you don't understand how to manage the risk that you have in your investment account. And that's a problem. So here's a bullish risk graph, or profit and loss graph. And the example here would be if we bought 100 shares of the stock like Starbucks at 50, that means our break-even price is 50. So if the stock went up above 50, we win. If it went below 50, we lose. We have a drawdown. So profits occur above 50, risk occurs below 50. Now, if the stock price were to rise to 51 and we had 100 shares, we would have a $100 profit. And the graph would actually just show you that what's what would happen if it went to 51, you'd have a $100 profit. If you had 1,000 shares, it'd be a $1,000 profit. If it rose to 52, the graph would rise to a $200 profit. If you had 1,000 shares, it'd be a $2,000 profit. If it rose to 53, you would have a $300 profit per, $3 per share. 1,000 shares would be a $3,000 profit, so on and so forth. So the graph is really, really simple. And the anatomy of it here is that the stock price is down at the bottom, 50, 51, 52, 53. $0 is break even, so you got that $0 right here. And you got your profits up above and your risk down below. And it's just a simple, simple graph. So that's where we get the graph picture. Now, on the inverse side of that, if the stock dropped to 49, you would be down $1 per share, or $100 on 100 shares. If it went to 48, you'd be down $2 per share, so you'd be down $200 on 100 shares, or $2,000 on 1,000 shares. If it went down to 47, you'd be down $3 a share, and that's where your risk is incurred. Now, of course, a smart trader and investor is going to know how to use a stop loss. They're going to know how to use options to protect themselves, because they remember risk is directly correlated to control. Now, this is the bearish version of that risk graph. See, if you sold to open, you have the exact opposite exposure, where if you sold the stock at 50, your break-even point is 50. If you bought it back at 50, you'd break even. So again, here is break even, and there's $50, and that's the break-even point. And so if the stock dropped to 49, that'd be a $1 profit, because you brought in 50, and it would only cost you 49 to buy it back. If it dropped to 48, you'd have a $2 profit per share. And if it would only cost you $48 to buy it back, but you sold it for 50. And if it dropped to 47, of course, you'd have a gain of $3 per share, 300 on 100 shares, 3,000 on 1,000 shares, so on and so forth. Again, if the stock rose, if it rose to 51, it would cost you $1 more to buy it back than you sold it for, and you would have to get the dollar from your account. So you would actually have a drawdown. If it rose to 52, it would cost you $2 per share more. And because you only sold it for 50, you would have to go get $2 from your account to buy it back. And 53, so on and so forth. So, that being said, it's important that we understand that. Now, I want you to understand that that bearish risk graph is a very, very powerful, powerful thing, because markets go up, markets go down, markets go sideways, and if you only know how to make money in the one direction because you put all your money in your 401k and you're buying those mutual funds they let you choose, or if you have all your money in your IRA and you're picking mutual funds, or you put your money in there with a financial planner who's out there picking stocks, they're only using a bullish posture, and it only works when the markets are going up. And I'm going to show you in a moment that there is huge, huge, huge risk out there. Now, here's one of the secrets of the market that you probably didn't know. People always say the stock market is so risky, but that's because they simply haven't taken the time to understand it. And the great irony is that there's no other place in the world where you can control your risk as much. See, when the markets go down and people's money, they lose on investments, and the markets crash and the money loses, well, what happens is that money comes from the bulls' accounts. It doesn't disappear. It goes into the bears' accounts. And it is a transfer of money, because at the end of the day, trading and investing is actually a zero-sum game. Money's not created, money's not destroyed, it simply changes hands. The markets are a redistribution system that takes money from the hands of people who don't know what they're doing and puts it into the hands of the people who do know what they're doing. So that's why it's so vitally important that you learn what these things mean. Now, never before in history have the markets been as accessible as they are right now. Never before has technology enabled us to take control of our retirement investments and trading accounts, to not only secure retirement, but to generate cash flow. You can learn to make money when the markets go up, you can learn to make money when the markets go down, and you can learn to make money when the markets go sideways. Now, why this is vitally important is because of what I'm about to tell you next. So it's really important that you increase your focus right now. The greatest stock market crash in history is coming soon. Now, I don't know if it's going to be this year. I don't know if it's going to be next year. What I do know is that September and October are typically the months in which major market crashes start to occur. If you have a 401k, if you have an IRA, if you own mutual funds, if you own bonds, if you have money, which we all do, and your currency is the US dollar, your money's at risk. we have a value of all global currencies are a little suspect right now because they're all fiat currencies. And I'll make a whole nother video about that so that you can understand it. But the value of our dollar fluctuates and it is at risk. That means your savings accounts are at risk. Banks are at risk. During the last economic meltdown, 700 plus regional banks failed. So little small banks failed because they could not withstand the blow of the markets crashing. And I'll make a whole nother video about that so you guys can understand that. Well, another thing that happened back in 2007 and 8 is that the credit markets almost seized. They came very, very close to seizing, which if that happens, that's like putting sugar in the gas tank of the car. It's going to seize that engine. And if the credit market seize, what that means is global commerce breaks down. And that means, your local stores can't borrow the money to get the products to put on the shelves. And pretty soon that's going to lead to job loss. People could lose their jobs. Now, I'm not making this video to frighten people or to scare people, but to make them aware, and so that they can be awake, so that they can protect themselves, so they can protect your families. Now, we have a huge potential crash coming, and the experts believe that it is going to be bigger than the crash of 1929 that led to the Great Depression, bigger than the crash of 1987, bigger than the crash of 2001 to 2002, the dot-com bubble, and bigger than the crash of 2007 and 2008, the subprime meltdown. So this is a big, big, big deal. Now, this is a current chart of the S&P index, and I'm going to show you that the market is currently in a bubble. The S&P recently closed not too far off its all-time highs at 2,077. The Dow's not too far off of its all-time highs. The S&P, the Nasdaq's not too far off of its its all-time highs, etc., etc. And the market has been being pushed up, stimulated up through stimulus packages, quantitative easing, economic policies that have been favorable, et cetera, and it's been pushing it higher and higher and higher and higher. Now, that doesn't mean it can't keep going up, but it is currently in a bubble, and it's the highest it's ever been. Now, this is 20 plus years of history, and you can actually see the recent crashes over here on the left. You'll see this was the dot-com bubble, and before it crashed, it slowed down, it gave us signs, and it dropped, boom. And then we had a nice 5-year bull market from 2002 to 2007, and you'll see it slowed down a little bit, and then big crash. And I'm going to actually show you very quickly here that the body language of the market is quite similar. So I'm going to go grab a little marker here. See if I can get that marker to play nice with me. Okay, so I got my little pen here, and I'm going to draw the tops, and you'll see that kind of curves almost like a baseball flying through the air. And you'll see that same pattern occur out here, and you'll see that we're currently seeing the exact same pattern. It's called slowing momentum, and it's caused by price action slowing down as supply and demand stalls out. So we're seeing that market slow down. It is in a big, big, big bubble. Now, the next chart I'm going to show you is what's called the Schiller PE ratio. And what the Schiller PE ratio does is it takes the price of the stock compared to the actual earnings of the stock. And a PE ratio is probably something you might be familiar with. It's a basic metric for valuation of a stock. If they look at the price of the stock, what people buy and sell it for, versus actually what they report in earnings, it's kind of a show me the money type scenario. They divide the price of the stock by the earnings, P, price divided by earnings, and the higher the number, that means the more out of whack the value of the stock is, if it's too high. So back in the dot-com bubble, it was actually insane because none of those companies actually made money. They were just ideas. So the current Schiller PE ratio rating is for all S&P 500 stocks, all 500 of them, is at 26.6. And it's only been this high a handful of times in history. And I'm going to take you back to 1929 on Black Tuesday. That was up around 30. The Schiller PE ratio was at 30. Stocks were overvalued, and then we had a huge, huge, huge crash. We had, in 1987, Black Monday occurred. It wasn't anywhere near as high. Back in the 60s, markets crashed, wasn't nearly as high. During the dot-com bubble, it shot through the roof because those dot-coms, the price-to-earnings ratios were so far out of whack. It was like, not uncommon to see a stock with a 300 or 600 price-to-earnings ratio because diapers.com apparently was a crappy idea, pun intended. So it just was something that was out of whack. Now, you'll see here, even in 2001 to 2007, it was around 26, 27 before the markets crashed. And we are now out there at those same highs. So you look at this history and you realize that the current market conditions, the price to earnings ratio of all those 500 S&P 500 stocks is higher than it has been, and it's in the area prior to where all those crashes occur. So that's why I would say we are in a bubble. So if you look at the market and how high it is, it doesn't mean it can't go higher, doesn't mean it's not going to keep going, but it is a warning sign for us that the valuation of the market is overextended. We are in a bubble, and bubbles pop. Now, one of the things I want you to notice is that the average bull market lasts about 5 years, and it took from 2002 to 2007 for the market to go from 800 to about 1600. So it took it 5 years, but it only took 1 year for it to drop. That's why the market corrections are so intense. That was a transfer of wealth. And the crash of 2007 and 8 was in fact the single largest transfer of wealth in the history of the world. If you knew how to be a bear, you got rich. If you had your money sitting in your 401k account, your IRA account, and mutual funds, you lost your assets. You got your stock assets handed to you. And your financial planner, your broker said, oh, that's okay, we're in it for the long haul. And over time, it'll recover. And you know what? That's possibly true because it certainly did come back. From 2008, we've been in now a 7-year bull market, 2 years longer than the average. We're out here 2015. Markets are still climbing, but we are in a bubble. It is slowing down. Markets on average begin those major corrections in September and October. Now, I'm not saying it's this year. It could be this year. It could be next. It may not happen at all. But the knowledge and information is incredibly important that you understand that we are setting up, that the bubble is here, and that the potential for downside risk is huge. And one of the things that you need to understand is that the next crash, according to many, many experts, is going to be the biggest crash in history because they simply put don't have the tools and strategies available to them to keep the markets propped up like they have in the past. So I want to bring you back to that risk graph. If you have your money in a 401k or in an IRA or in mutual funds or even in savings accounts, I mean, it doesn't really matter where you have it, you only have a bullish bias. And the traditional methods of diversification, like putting your money in a bunch of different stocks in a mutual fund, doesn't work because diversification is only a hedge against ignorance. It is only a hedge for not knowing what else to do. And the markets are 80% correlated. What that means is it didn't matter what mutual fund you were in. When the market crashes, every last one of those stocks is going to go down. A rising tide will lift all the boats in the harbor. And when the tide goes out, it is going to take everything out with it. And every mutual fund is going to get crushed. And those mutual fund advisors are still going to charge you their 1.5-2% fee, regardless of performance. So it's not just an insult, it's injury, adding insult to that injury. So boom, this is what you have yourself exposed to, downside risk. So whatever gains you have are at risk. Whatever money you've put in is at risk. And when you look at that risk to reward and the market's been doing great, you probably feel really good about what's going on right now with your accounts. If you've been putting money in faithfully, congratulations. But the time's come for you to do something to protect it. Because the downside risk, if this is the S&P index and you look at what's coming down the pipeline and you have your money in those IRAs, 401ks, mutual funds, etc., they're forecasting a 60% drop in the market, which means you'd see 60%. That means you're talking about an S&P down around 400 to 600, 500 in that ballpark. And regardless of how much money you think, so if you thought you had $1 million, well, it's very easily going to turn into just $400,000. If you thought you had $100,000, it's going to very easily just turn into $40,000, and it's going to take less than a year, and it's going to be the type of thing that the potential recovery time this time around is going to be a lot harder hit because of what's going on in the big global economic picture. And again, I'll make a whole nother video about that so you can understand that. The point of this is that a fool and his money are soon parted. And there is a storm coming. And if you have been conditioned to believe that the stock market is risky, it's because you haven't learned how to control the risk, and you're not the one in control. If you've been conditioned to believe that the stock market is too complicated for you to understand, that's a myth. You understood this video. You understood everything I just explained to you relatively easily. If you've been told that a mutual fund is a safer way to invest and that diversification of the mutual fund will benefit you over the long haul, that's a lie. It is simply not true. We can prove it mathematically. All you have to do is go back in history, look at the last few crashes, and you can track the performance of mutual funds, and it is as plain as the nose on your face that it is a completely unprotected asset. And if you've ever wondered why the 1%ers out there, the wealthiest people in the world, are, do know how to invest and do know how to trade for themselves, the question you need to ask yourself is, why are you not doing the same things they are doing? Why are you doing what they tell you to do? Why are you following along with what the financial planners suggest or the financial experts suggest? You need to be the financial expert, and that's why we're here. So again, this is Noah Davidson with TackleTrading.com. We are inviting you to get in the game. Come over and find us. We'll explain to you how the rest of the story works.
Isn't it time you got off the sidelines and tackled trading? Join our online community of active traders where we make it happen every day. Stocks, options, futures, and Forex at www.tackletrading.com. Get in the game.